Welcome to the deep dive. Okay, today we are diving into something that's just rocked the crypto world. Bitcoin falling clean through the $100,000 mark. And look, this isn't just any number, right? It's this huge psychological line in the sand. 4 months of holding and then poof, gone. It feels like a major support beam just crumbled.
It really does. And everyone's asking, okay, what just happened? Why did the market suddenly let go like that?
Exactly. Is it just, a quick panic sell-off? Or are we looking at the beginning of something deeper?
That's what we need to figure out today. Our mission really is to understand the why. Was it just market nerves, or is there something bigger, maybe something lurking from weeks ago finally hitting us? We need to look at the technical side, the immediate shockwaves, and this really quite chilling theory about institutional trouble.
It's a real puzzle because the selling pressure is just immense, relentless. But analysts aren't pointing to one big event, like some political news or economic data. It feels more mechanical.
Pure market mechanics breaking down. Yeah, the sellers are just completely overwhelming anyone trying to buy right now.
And that lack of a single clear reason, well, that just makes things worse, doesn't it? It feels uncertainty.
Absolutely. When you don't know why things are falling, fear tends to fill the vacuum.
Okay, so let's start unpacking this. Where's the fear most obvious right now? I guess the exchange-traded funds, the ETFs.
Definitely. That's a great place to start.
For anyone maybe newer to this, an ETF, it's basically like a managed basket, right? It holds Bitcoin for investors.
Yeah.
It's how a lot of traditional folks get exposure without actually having to, hold the coins themselves.
Exactly. And the way they signal confidence or lack thereof is pretty simple. Inflows versus outflows. Money flowing in means people are buying ETF shares, feeling good. The fund then has to buy more Bitcoin. That supports the price.
But right now,
We're seeing heavy outflows, big time. And that's a clear signal of, well, decreasing confidence, fear maybe.
So outflows mean people are selling their ETF shares, cashing out,
Right.
and the fund managers, they have to sell the actual Bitcoin they hold
Yeah.
to give people their money back.
Which creates this constant heavy selling pressure hitting the market, a steady stream of supply.
And that supply, it seems like it ran smack into a wall of borrowed money. Leverage.
Bingo. This is where it gets dangerous. We need to talk about liquidation. So, leverage, simply put, is borrowing money from an exchange to make bigger trades, bigger potential wins.
But also bigger potential losses. Much bigger.
And if the price moves sharply against you, the exchange doesn't, call you up politely if your losses hit a certain point.
They just force sell your position automatically to get their money back. That's the liquidation.
And those forced sales, they dump more supply into the market, pushing the price down even faster. It's a cascade.
So we looked at some data, right, from HighBlock, their liquidation heat map. What did that show us around the $100 KO mark?
Yeah, that heat map is fascinating. It basically shows you where big clusters of this borrowed money, these leveraged positions, are sitting, like financial landmines.
And $100,000.
It was loaded. A huge concentration of leveraged buy orders right there. People were betting hard that $100K would hold. So when the price slipped just underneath, bang!
Automatic liquidations triggered.
A wave of them. Their forced selling just hammered the price, confirming that psychological break below 100K and sending it lower still. A really vicious domino effect.
So the initial slip triggered a flood of forced selling, making the drop much, much worse.
Precisely. And HighBlock put out a warning right after that. They said the zone just below $100, stretching down towards, say, $88,000. It's an area of thin liquidity.
Thin liquidity, meaning not many buy orders waiting there.
Yeah.
Not much support.
Exactly. It's like falling through air. If the price tumbles into that zone, there's not much there to stop it or even slow it down easily. It could drop fast.
The path of least resistance is down, it seems.
Which leads us right to where traders are looking next. That consensus target range seems to be crystallizing around $88,000 to $95,000.
Okay, but then you have some traders, like Horse, suggesting maybe, just maybe, this drop below 100K was a deliberate trap to shake out weak hands before a big bounce.
Yeah, that theory's out there. The shakeout theory.
How likely does that feel right now, though, with this much downward pressure?
Well, Horse himself adds a really important condition. If the market doesn't reclaim $100,000 and, fast, then the psychological damage is probably done.
Right. A big round number like that, once it's definitively lost, it becomes resistance instead of support. Hard to get back above it.
Exactly. The longer we stay below, the more likely that move towards the 88K and 95K range becomes. It solidifies the breakdown.
So reclaim it quickly or face the consequences. Okay, zooming out a bit. The technical analysts looking at longer-term charts, people like Scott Melker focusing on moving averages, the picture gets, well, even more sobering.
It does. Moving averages, MAs, are super important technical levels. They basically show the average price over a specific period, like 50 weeks or 200 weeks. They act as major support or resistance.
And it's not just math, right? It's about behavior.
Totally. Think about the 50-week MA. That's the average price over the last year. It kind of represents the consensus value for longer-term holders over that period. When you break below it,
It means pretty much everyone who died in the last year is now underwater, losing money.
precisely. And that triggers a lot of fear, both retail and institutional. And guess what? That $100,000 level we just lost
Don't tell me it was right on the 50-week MA.
pretty much sat right on it. So technically speaking, we didn't just lose a round number. We decisively lost the 50-week MA as support. That floor is gone.
Okay. And Melker's analysis.
Mm-hmm.
What's the historical significance of losing that 50-week MA?
This is the key part. According to Melker's research, this has only happened like 4 times before in Bitcoin's history, and every single time it happened.
Uh-oh.
It eventually led to a test of the 200-week moving average.
Wow. Okay, the 200-week MA, that's like the 4-year average price, the ultimate long-term support line.
That's the one, the bedrock support, historically speaking.
And where? Where is that 200-week MA sitting right now?
Is currently hovering around $55,000, and it's slowly rising, but yeah, around 55K.
Okay, deep breath. So Melker isn't saying we're going straight to 55K tomorrow.
No, definitely not. He's highlighting a very serious historical pattern. Losing the 50-week MA, especially after such a psychological blow at $100K, statistically opens the door to a much deeper potential correction if this current selling wave continues and that 88K, 95K area doesn't hold strong.
So the historical precedent is worrying, if history rhymes.
It often does in markets.
Okay, so we understand how the price fell, the ETF outflows, the liquidation cascade, losing key technical levels. But it still feels like there's a missing piece. The sheer volume of selling, it feels bigger than just recent panic. Who is doing all this selling?
This is where we get into that institutional theory. The one that connects this current mess back to that huge $20 billion liquidation event we saw back on October 10th.
Right, that crash felt like ages ago, but analysts like Tony Stewart are saying this is the aftershock, the delayed reaction.
Yeah, Stewart's hypothesis is basically one of institutional paralysis.
Paralysis. What does that mean? Why didn't these big funds just sell back in October if things were bad?
Because they were holding so much Bitcoin and the price dropped so fast back then. If they had sold immediately in October, they would have locked in such massive, catastrophic losses that it might have, well, destroyed their funds entirely.
So they were stuck, holding on to huge losing positions, just hoping for a bounce back to break even, or at least to a less painful exit point.
That seems to be the idea. They were paralyzed, hoping for a recovery that just didn't really materialize strongly enough or quickly enough for them.
And now? Why sell now at even lower prices? Is it a choice, or are they being forced? We keep hearing about margin calls.
That's the suspected trigger. Margin calls, pressure from their own investors wanting money back, maybe needing cash for other obligations. It forces their hand. It leads to what's called institutional deleveraging.
Deleveraging, meaning they have to sell assets, reduce their debt, reduce their risk, regardless of the current market price.
Exactly. It's forced selling, driven by internal or external financial pressure, not by a view on where Bitcoin's price is going next. And this kind of selling can be relentless.
Stewart used a really striking metaphor for this, didn't he? Something about underwater images.
Yeah, he called these struggling institutions the faint images underwater, or financial corpses, that are now finally being forced to surface. They have to liquidate those massive Bitcoin holdings they were stuck with.
Financial corpses.
Yeah.
That's grim.
It paints a picture, doesn't it?
Yeah.
And the big worry, if this theory is right, is that we just don't know how many of these corpses are still out there.
We don't know how much Bitcoin they still need to sell, or when that selling pressure might finally dry up.
Exactly. That creates this huge overhang of uncertainty. Until that forced institutional supply is absorbed, it could keep pushing the market down even if retail sentiment starts to improve.
Okay, so that brings us to the so what? For you, the listener, trying to make sense of this. We've got this like perfect storm, a psychological break at $100K, a technical breakdown losing the 50-week MA, and this potential wave of forced institutional selling.
Yeah, it's a tough environment. And the first big takeaway, echoed by pretty much everyone, is emotional control. Easier said than done, I know.
Right. Markets run on greed and fear. But you absolutely cannot let panic drive your decisions. Selling deep into a crash often just locks in the worst possible outcome. You need a cold head, as they say.
Totally. And the second lesson comes straight from that liquidation cascade we talked about. It's a brutal reminder about the dangers of leverage.
Don't borrow money you can't afford to lose to trade volatile assets. It seems obvious, but
People get caught up. The key is knowing your own risk tolerance, really understanding it and sticking to it, no matter what.
and finally,
Knowledge and patience. Look, even the pros are struggling to pinpoint the exact cause day to day right now. That tells you something. It highlights why you need to do your own homework, understand why you're invested in something long term, if you are.
right. Don't just follow rumors or react to fear. If you believe in the underlying tech or asset long term, then volatility, even scary crashes like this, are part of the journey. Patience becomes key.
It really does. This isn't a smooth ride.
So to wrap up this deep dive, the market's caught between two powerful forces. On one hand, the technical damage points towards that 88K, 95K zone as the next critical test. On the other, you have this potential slow bleed from institutions being forced to deleverage.
Yep, that's the battlefield right now. Which leads us to maybe a final thought for you to chew on. Everyone's focused on whether 88K, 95KK will hold. Fair enough. But thinking about Scott Melker's historical analysis.
The 50-week MA loss leading to a 200-week MA test.
Exactly. If that historical pattern is playing out again, maybe the bigger, longer-term question isn't just if we stabilize around $90, but maybe it's when does the market need to start mentally preparing for the possibility of testing that $55,000 level down the road?
Wow, that is definitely a sobering thought. A question of whether this is just a correction or the start of revisiting much deeper historical support levels. We'll have to keep watching those charts and those financial corpses. Thanks for joining us for this deep dive.